Please kindly mute your mic if you are muted. Please give me like a minute. I want to set up the live stream, the YouTube to precise, so that others that are unable to join can be able to watch us live. Because I think this one is full already. Yeah, we are 100 already. Even if I keep admitting them, it's not going to work. So, please a minute. Okay. So, good evening, everyone. Once again, I think we're all set.
Good evening,
Sorry, can
sir.
anyone confirm? Okay, thank you. Thank you very much.
Good
So,
evening, sir.
I trust we all have a good day. And it's been hell of a day, actually, but thank God it has come to an end. And yeah, apologies for missing the last two classes. I mean, I had a couple of things that I was doing, so I was a little bit busy. So today we just move straight to what we have to do today, which is transfer pricing, as shows on the notification that I sent this morning. So, and like I mentioned in the last class, I usually like to take the questions that, I mean, the topics that I can focus more on. I mean, the one they test frequently before moving to the lesser ones. I will have taken standard costing or variance analysis, but I noticed you guys typed yesterday. So I just decided to switch to transfer pricing today, which is like the third most asked question according to what do we call it? According to the ICANN Pathfinder or past question. If you check your past question, you realize that variance analysis or standard costing is the most asked question. Then we had ABC for coming next, and then we had transfer pricing before the likes of budgeting and boom. So let me share my screen. Please confirm when you can see my screen. Um,
We can see the screen.
I mean, I already shared the documents with to the class groups. So if you are unable to see my screen, you can just follow us on the slides or something like that. Sure. Let me check those that are on YouTube to see if they are with us. Sorry. It's. Okay, can those on YouTube confirm that you can hear me? Someone should just. I'm not seeing that. Can anyone on YouTube confirm they can hear me? Okay, okay. I got an answer. So today we'll be going to into transfer pricing, just like I mentioned. So, and what are we going to be covering this night? We'll talk about the concept of transfer pricing. What is transfer pricing? And it is these methods that will lead us to what we call opportunity costs in transfer pricing, and then we will wrap it up with how to determine the ideal transfer prices, or how to calculate transfer prices or transfer price range, or whatever the question may ask us to do. So without wasting much of our time, let me just dive right into it. Um, okay. I think my screen should be more visible. Okay. So when we are talking about transfer pricing, the ideal thing that we are all used to is, oh, I want to buy this particular product from this person, and yeah, you just go into the transaction and you pay for the goods, you get the goods, and everybody's happy. So please give me a minute. Yeah. So you just order for your goods and then you get your goods, and that is it. But in some situations, we can have two divisions under just one company. So for this graphics, this illustration, you can see that we have Apex Tutors as sorry as the broad company, or as the company, and then we have two performance management groups under Apex Tutors. Apex Tutors controls both companies. Now, this performance management group one is set. This is why his presentation made. Is selling what performance management group two needs. Let's put it in context. Um, what goods can we use? Okay, let me say bicycle, my favorite example. So yeah, this performance management group one is selling tires, while performance management group two is selling the bicycle. There's no way performance management group two will produce their full bicycle without buying tires. So now, performance management group two will transfer their tires, the tires they produce, to performance management group two. So in exchange, group two will pay them. Now, what they pay them is what we call the transfer fee. Now, at what price should should group two be buying from group one is what we call transfer price. So if you come down here, see the definition of transfer price here. So transfer price is the price at which goods or services are sold by one division within a company to another division in the same company. For you to call it transfer or transfer price or whatever, it must be within the same company. Like both group one, both the buyer and the seller must uh must be under the same company. So they said internal sales are referred to as transfers. Unlike when you buy or sell to an external buyer, we call it sales or purchases, either of the two. But when it is an internal dealings, we call it transfers. It is a transfer between divisions. So that's why they said internal sales are referred to as transfer. So the internal selling and buying price is now what we call transfer price. So what price should this guy, which is group two, be buying from group one? Transfer price. What price should this guy, which is group one, be charging group two for its product? That is the transfer price. So now, what are the objectives of transfer pricing? Uh sorry, those on YouTube, I think this is the highest that I can do for the boldness. You can just go ahead and increase your video resolution or something like that. I mean, we say this almost every class. Please just go ahead and do that. And if it's still the same, then we can check what's wrong. So, okay. So the objective of transfer pricing, it has three major objectives. Number one is to make it possible for divisionalization to operate successfully within a company. Now, look at this scenario now. We place both groups beside each other. Not that group one is under group two. But imagine in a situation where whenever performance manager group one, or let me just be calling it group one, whenever they produce their tires, the only thing they do is, oh, they send it to group two, and that is all. Group two is not paying for anything. They are just, you will realize that at the end of the day, group one will eventually become a subsection of group two. Because once group two, once they fuck up, I mean, once they stop operation, that means group one, if they are producing their tire, there's nowhere they are sending it to. So in that case, they will just stop. They will stop production. So that means you are not really operating a divisionalized system like that. You are just doing a group production. So transfer price makes it possible for divisionalization to operate successfully in a company, since we know that, oh, whatever we produce in this division, we are selling to the other division. It's not just that we are transferring for free, not like we are subordinates to the other division. So the second one is it gives autonomy, that is freedom to make decisions to the managers of the profit center or investment centers. Now, these profit centers or investment center, we will deal with them more in the next topic, which is what's the name of this topic? Divisional performance. We'll talk about return on investment and all. So, but for now, let me just stick to this autonomy. So, when you are the manager of group one, I am very, very sure that you will not produce your tires and sell it at a ridiculous price to group two, prices that will make you run at loss. I'm sure no one will do that. So when there is, but imagine there's nothing like transfer price. So there's nothing for the manager of division one to, or manager of group one to decide. So at the end of the day, your own is just to produce and send, produce and send. So, but with transfer price, at least the manager of group one can make decisions concerning that, and then it enables the company to measure the performance of each division in a fair way. So it's a profit center. So at the end of the day, if you're not making profits, it can easily be flagged when transfer pricing is in place. But so those are the objectives of transfer. So is my screen not really clear? Can anyone else on YouTube confirm that my screen is clear enough? So I'm waiting for a response from one of them. Okay, good. Ah, I'm getting both response. The screen is fine. It's fine. Okay, yeah, good. So aside from the objectives, now what are the methods that we use to set transfer price? I mean, this we could have developed more on this, but we really don't need them. I'll just explain what each one of them is doing. But majorly, we need these two, the number one and number four, transfer at marginal cost and then transfer at market price. So now, let me take them one after the other. So when we say you transfer at marginal cost, I mean, we all know what marginal cost is saying. So marginal cost is more like the cost of producing an additional product, which is also the same thing as your variable cost. So it means that when you are setting your transfer price, if you are using the marginal costing method of setting transfer price, it means that your transfer price is just your variable cost, as simple as that. So if I spend 100 naira as variable cost on this product, and I spent okay, let me say 300 naira is my variable cost and 200 naira is my fixed cost, per unit. So if I'm using the marginal cost method, I have nothing to do with the fixed cost. My transfer price is 300 naira, which is my variable cost, and that is all. So simple. So see the same thing for at full cost. So when goods are transferred at, goods are transferred at total cost, which includes both variable and fixed cost. So like from the example that I just cited now, 300 variable cost, 200 fixed cost. So if you are transferring at full cost, you add both your variable and your fixed cost together. That should give us 500 naira. So in that situation, your transfer price is 500 naira. So that is for those two. Now, note that I did not mention anything about profit or contribution when I was talking about these two. Now, these two are usually used when they are a not profit-making division, like their objective is not to make the profit. But these last two, we use them for profit divisions, profit centers. So transfer at cost plus, which is the third one. Now, what this one does is, in this method, you add a certain percentage to your costs, then you charge it as your transfer price. Now, this can, we can split it into two. Let me indicate that. I read it again. So it can either be marginal cost plus or fixed cost plus.
I can't see the screen.
Can anyone confirm you can see my screen or you cannot? Anyone?
Yes, I'm visible. Your
I
screen
can
is
see your
visible.
screen.
I can see your screen, sir.
So it's most likely your network. You can check that. So all right. Now, as I was saying, it can either be marginal cost plus or fixed cost. Not fixed cost. Sorry, please mute your mic. I don't want to be. Please mute your mic. You are the one. Jesus. Adola, please. I don't want to mute you. Okay. All right. So whichever one you are choosing, either it is marginal cost plus or full cost plus. Now let's say I want to be adding a 10% on my, I want to be making a profit of 10% on my product. So if I'm using marginal cost, so for the examples that I've been using, it will mean that, oh, I will just add 10% to my marginal cost, which is the 300. So that means I'll add 10% to 300 and I will get 330 naira. That is my transfer price. And if I'm using the full cost plus, if you charge 10% on 500, you say, oh, my transfer price is 550 naira. That is the transfer at cost plus. And then the last one, as the name implies, transfer at the market price. So I don't even want to know how much I produce it. But as far as the market price is available, I'm transferring it to you at the market price. Now, in this one, you can either run at loss or at profit. That one is your problem, because if you produce at 500 and the market price is 450, you are selling at 450. If you produce at 500 and the market price is 2000, you are selling at 2000. So those are the methods that we use. Now going forward, we might not talk about these two again, which is at full cost and cost plus. We will continue to talk about this marginal and the market price, especially the transfer at market price. You know, this is the one that that represents reality. I mean, you hardly see a company that will be transferred to their variable cost, but let's just go on. So moving on.
Hello, sir. Please, I have a question. Don't be angry.
Okay, guys.
Okay, you said the first two are used for a non-profit making company, while the second two are used for profit making company, right?
Yeah.
Can you explain number two and number three very well? I don't really understand what you mean by I'll add my 10% and the 10% I'm adding, like the number two and number three, they are looking same to me. I don't know if I'm the only one. I don't know.
Okay, I'm coming. Let me do like a mini example here. Okay. So let's do for the second one. You know, I said my variable cost is 300, right? And my fixed cost is 200, I think so. And my total cost is 500. Yeah, I think this is what I'm using. Let me format it the right way. Okay. So if we are using the second, okay, let me say if we are using the first one, which is the marginal cost, our transfer price is our variable cost, which is this figure right here, 300. That will be our transfer price. But if we are using the full cost, you know, our full cost is the addition of our fixed cost and our variable cost. So which gives us a total cost of 500. So we are using the full cost method. Then our transfer price will be this 500. Now, so you notice that for both 1 and 2, there's no way you will make profit. There's no way you cannot make profit, because if you are selling at what your total cost is, that means your profit is 0. Here you're even running at loss. It's just that you are not making any contribution. So if you transfer at marginal cost. So, but for the third one, which is the cost plus. Now let me say, oh, I've produced this product and I felt like, oh, on this thing I should be able to make 20% profit. That is my decision. I want a margin, or let's say markup, because I'm using cost. So I want a markup of 20%. So I want a markup of 20%. Now I'm talking about number 3 now. So in this case, you know, I told you that it can either be marginal cost plus or full cost plus. So if I am using marginal cost plus, it will mean that this 20% will be on my variable cost. This variable cost. So it will mean that my transfer price will now be 300 plus 20% of 300. What is this in capital? Of 300, which should give me 360 at the end of the day. But if I'm using the full cost plus, it will mean that I'm using the total cost here, which is 500. That will now mean that my markup will be based on 500, and this should give me 600. So you can now see the difference between 2 and 3. Under 2, Your transfer price is just your full cost or your total cost, and that's it. But under 3, you must have a certain percentage that you want to add to your cost, and that will now be either your that will be your markup. So you add that percentage to the cost, and then that will be your transfer price. I think that is clear now.
Yes, thank you very much.
You're welcome. So let's go to opportunity costs and transfer price. Now, ideally this should come after this example, but I just like to treat it at edge so that we understand the concept. And when we get to that last one, we will not be surprised. Now, we all understand, I want to believe that we all understand what opportunity cost is. What we call opportunity cost in the accounting or costing or anywhere. So opportunity cost in literal time or in simple time is just the alternative forgone or the amount lost or alternative lost or whatever we decide to call it. Now, when we are setting transfer pricing, let's say group 1 wants to set their transfer price. So let's say, oh, I'm producing these tires at 500 naira. Now there is performance group 3. You know, group 3 is not in our company. In our company, we only have group 1 and group 2. Now let's say performance management group 3 is an external tire now. They want to buy this thing from me at 1,000 naira. And I look at it, and ideally, you are not expected to make profit in an internal transfer or in a transfer. You are not, because of course, if you make profit, let's say you bought it 500 and division, or you produce it 500, the group 2 bought it from you 500. The 200 naira is still coming from Apex. The 200 naira gain is going to Apex. The 200 extra that division B or group 2 is paying is still coming from Apex. So at the end of the day, you always have a net of 0 when you are doing internally. So if you like, make 1 billion profits from your counterpart, your internal counterparty. At the end of the day, the company itself makes a 0 profit from internal sales or from internal transfers. So now talking about you not making profits, it means that, oh, I have to transfer these goods at 500 ideally to group 2, but there's this guy outside that wants to pay 1,000 naira. Now you now look at it. If I deal with the group 2, how much am I losing? You'll be losing 500 naira, which is the difference between what you could have sold it to the external party, which is 1,000, and what you are eventually selling it to the internal party, which is 500. So if you less 500 from 1,000, you get an opportunity cost of 500. So let's just read what we have here. So we said the selling division and the buying division have opportunity cost of transferring goods internally, where there's an intermediate external market. Now, of course, the same way it works for the seller, it also works for the buyer. You know, you want to sell to me at 500, but somebody somewhere already said I should come and carry this thing at 300. Why should I buy from you at 500? So in that case, it will mean that once group 2 buys at 500 from you, they had to pay 200 naira extra, which is an opportunity cost to them. So the same way you can have opportunity cost for seller, you can also have it for the buyer too. So they said for the selling division, the opportunity cost of transferring goods internally to another division might include a loss of contribution and profit from not being able to sell goods externally in the intermediate market. Just like I mentioned, the 500 you are losing simply because you could not sell to group 3. And also for the buying division, the opportunity cost of buying internally from division is the price that it will have to pay for purchasing the item from external supplier. Now this particular, they've asked twice. and I think it was a 5 mark or I think 3 marks question each. What is an ideal or what is an optimal transfer price? So this is everything you are meant to say for the 3 marks. I think the question should be part of the question we solve eventually, but so you can just note this. What is an ideal transfer price, or they say what is an optimal transfer price? Still saying the same thing. So an ideal transfer price is just a price at which both the selling and the buying division will want to do what is in the best interest of the company as a whole, because it is also in the best interest of their division. So simply put, it is a price that both division A and division B, they'll be willing to transact. Oh, 500, I'm producing this thing as 500. You say you can see 300 somewhere. Me, I know that I can sell it 1,000 outside. So let's just find a way to juggle this thing. Let's agree at a certain price. So that price that both group 1 and group 2 are willing to transact, simply because, oh, it is in my own best interest as the buyer. Also, it is in the best interest of the seller, and overall, the company as a whole, it is also in the best interest of the company as a whole. So when you put those three together, you can now have an ideal transfer price. You cannot have a price that is making a company lose and you call it an ideal transfer price. No. So usually an ideal transfer price ranges from the variable cost of the selling division to the purchase price available to the buying division. So this simply means that the variable cost that the selling division is producing should be the minimum they should ever sell. Because the moment you start selling below your variable cost, it means that you are having a negative contribution to the company. And that means that very soon your division will be closed down. That's just the meaning. And also, the maximum that the buyer will be willing to pay is also what he can get it outside. I mean, why should I buy at you? Why should I buy from you at 700 while I can buy from an external party at 650? So the maximum they will want to pay as in the buyer now will be the amount that they can get it from an external party, the purchase price that is available to them. So that is usually the range of a transfer price. So don't forget this particular place, because we will continue to even use this second paragraph often and often. So ideally, a transfer price must therefore take opportunity cost into consideration. Yeah. Okay. So moving on. I mean, this class is going quite fast. I hope we finish in a good time. Okay. So now, how do we now determine the ideal transfer price? This is where questions usually come from. Yeah. So how do we determine the ideal transfer price? So these steps are just let me just say for book purposes. When we are dealing with calculation, we'll most likely not even come back to all these stages. But let's just do it as it is. So the stages of an ideal transfer price, you first of all identify the price that will maximize the profit of a company as a whole. It has to be in the best interest of the company. Also, you identify the transfer price range that will maximize the profit of the buying division. It's usually from variable cost to infinity. I mean, the lowest they can go is their variable cost. But of course, if they produce it at 500 naira and you want to buy it at 1 million naira, who are they to say no? They will collect it. If you say you want to buy it at 2 million, they will still collect it. So usually for the buying division, for the selling division, so I've even switched it. For the selling division, it is from their variable cost to infinity. But for the buying division, it is from 0, even if you can add money for them, they will even collect it. But the maximum day they will want to pay is the price they can get it in the external market. This guy will be willing to pay as low as 0 naira to buy the product, but the maximum they can do is the price they can get it from the external market. Whereas this guy, the minimum they can do is their variable cost, but they are willing to collect as much as possible. Now you see that we now arrive back at this particular second paragraph. So this guy, the minimum they can do is their variable cost, but this one does not have any minimum. So in that case, the minimum that the transfer price will be set as will be the minimum for this guy. On the other hand, this guy has a maximum of its external purchase price, but this one has no maximum. So the maximum will be set will be the maximum for this guy. So at the end of the day, we have a minimum of this and a maximum of this, which is also the same thing here. It ranges from the variable cost of the selling division to the purchase price available to the buying division. So that is how we set the ideal transfer price. So before we go into where we start doing calculation, does anybody have any questions so far? Does anybody have any questions so far? Are there answers? I'm not seeing. Let me check.
I have a question, sir.
Oh, okay. Go ahead.
Okay, thank you very much, sir. Sir, when it comes to transfer pricing and questions, when it comes to calculation, what are the things that we should look out for? What are the questions we should ask ourselves? What do I want? What should I look out for in a question as pertaining to transfer pricing? Is it the markup? Is it the margin? Is it the okay, I just want us to give us a clue, and based on how I can set the questions and what should be our key guidance in topics like this when solving a question on transfer pricing. Thank you.
All right, thank you for the question. But just like I mentioned, I asked if there are any questions before we move to the calculation. So ideally, transfer price, you cannot say, oh, this is what I'm going to face or something like that. Almost all questions comes in their unique way. So when I get to the calculation, you will see different scenarios that we can have if you've gone through the slides that I shared, you will see that you have 3 different market conditions, and of course the 3 of them, they do test them. So it just depends on the way the question is structured, and of course we will solve some of the questions here in class before. So you will see how questions are set and what are the key things you should note. Everything will be done when we get to the question solving part. Did I answer your question? I mean, I was not able to give a specific to what you asked, but we will get there with time.
Yes, sir, you did, sir. Thank you, sir.
So, okay, let's just continue. In the absence of no other questions. Okay. Let's go again. All right. So now, usually you can have 3 types of conditions when we are trying to determine our ideal transfer price. The first one is if we don't have any external market, that is, division A only produced for division B and nobody else. 2, when there is external market and there's no production limitation, and 3, with external market and production limitation. So those are the 3 conditions. We pick them one after the other. So in a situation where there is no external market, so they said if the selling division is a profit center or an investment center and there is no intermediate market for the transfer item, so transfers should therefore be a negotiated cost plus price to provide some profit to the selling division. So simply put, if there is no market to judge, so you just pick, oh, I think I should be able to make 10% profit on this division. So that is what you set as your transfer price. It is always a negotiated transfer price. It should be negotiated. If you look at this question now, they said a company has two divisions, division A and B. A makes a component X which is transferred to division B. Division B uses component X to make end product Y, blah blah blah. So details and cost of the selling price as follows. So division A has a variable cost of 100 and fixed cost of 80. Division B, variable cost of 40 and a fixed cost of 70. The selling price of product Y is 400. What is the ideal transfer price range of price that would be ideal? Now, you know, I said, since there are no external markets, all you have to do is negotiate. Now, for Y, of course, division A already knows that the minimum they can go is this 100 naira here, which is their variable cost, just like we mentioned earlier. For an ideal transfer price, the minimum should always be the variable cost of how do you call it now? Of what's the name again? Of the selling division. While the maximum should be the purchase price. Now, note that there is no market price now. So that means division B cannot buy it externally. Division A cannot sell externally. So the two of them are stuck together. It's not that either of them has option. A cannot sell to an external party because, of course, there's no external market. B cannot say, oh, I'm not buying from you. I want to go and buy from Mommy Kiniko that is down there. There is no external market. So that means the two of them has no option. They have to buy from each other. So how do we now determine the ideal transfer price? Now, this one will always be range. It should be range, not just a transfer price. It has to be a range. So we are done with one leg of the situation. That is, we've gotten the minimum, which is 100 naira. Now, how do we now calculate what should be the maximum now? Since this guy does not have anywhere that he can, you know, assuming products wise, probably they told us that, oh, product Y can get this thing at 200 naira from an external buyer. Of course, our life has been made very, very easy. So the transfer price range will just be from 100 naira to 200. That is the minimum to division A, 100 naira, and the maximum to division Y, which is the purchasing, the available purchase price, 200. But here we don't have anything like that. So what you do is you calculate. I hope this place will be enough. So for division division B. Now you know division B is selling their products at how much? They are selling it at 400 naira. And for them to sell at 400 naira, they must have spent variable cost of 40 naira plus a fixed cost of 70 naira. It shows that they have how much now? I think 290. Is that it? 110, 200.
Yes,
Yeah.
ma'am. 110.
Yeah, 200. So it means that any amount that they want to buy products, component X from division A, it must not be more than 290. Once it is more than 290, they start running as loss. I don't know if you understand what I'm saying. Now, this is it. They will buy component X from division A. After that, they will spend 40 naira as variable cost again. Still spend 70 as fixed cost, and at the end of the day, sell it 400. So since we are not sure how much they want to get component X from division A, but we are sure of the other cost. So we remove the other cost, which is this 40 and this 70 from their selling price of 400. So we should give us 290 naira as what they have left. So in that case, they must not buy at a price that is more than 290 from division A, or else they will start running at loss. Imagine they buy it at 300. 300 plus 40 plus 70 plus 70. That means their total purchase, production cost will be 410, whereas they only have 400 as their selling price. So now that we have gotten their own maximum too, we can easily determine, I believe that we can easily determine our transfer price range. It's just equals to 100 naira to 290. So the two of them will now come together. They will negotiate among themselves. Oh, let's do 150. No, let's do 200. Blah blah blah. It must fall between this range. So that is that when there is no external market.
External market.
So let's go to the second one, which says, what is the ideal transfer price now when there is external market and no production limitation? So let me just ask the general class, what do you think is the highest production limitation that a company can get?
Material.
Nice. Any other opinion?
Labor.
Labor. Material labor. I think we should do poll. She see who will win. Material labor. I need a tiebreaker or something. Because we're now 50-50. I need another answer. Material labor.
Sales. Sales, sir.
Oh.
Sales.
Yeah?
I said sales. Yes, sales.
Is sales
Machine.
limitation? Machine. But anyway, to save our time. Well, the guy that said sales, you will have been correct. But it is not sales. The answer is demand. I mean, demand is the highest production constraint that you can get. If you don't have enough material, I mean, you can always get material, even though it might come at higher cost, but you can always source for material. If labor is your constraint in this Nigeria, you even have enough labor, people that are willing to work, you can always go for more labor. But once people say it is two of your product that we want, if you like, get material to produce 5,000. If you like, get labor to produce 1 million. You can only produce that two. Because the moment you produce 3, it means that you are eating the third one, or you are using the third one yourself. So that is why. So when we say no production limitations in this particular context, most likely we are talking about demand. So that is, they don't have any limit to the number of them. So if I produce 5 billion units today, demand will be able to take up the whole 5 billion. That is what this one is saying. So then I said, when there is no external market, when there is external intermediate market and no production limitation, in this case, when there is an external intermediate market for the transferred item, a different situation applies. If there are no production limitations in the selling division, the ideal transfer price is usually the external market price, and it is always the external market price. As far as I don't have any production, that means if I have 5 billion units and I want to sell it as 5 billion or 5 million or 5,000, the market is ready to accommodate that. So why should I sell to the guy that is inside at a lower price? It's not reasonable. Let me just sell everything to the external party as far as they are willing to collect everything that I want. So it is always the market price. So if you go through this question, you don't need to. Once you see anything like division, the selling division can sell as much as they want to the market, or there's no demand limitation, you don't need to bother yourself from the question. Just go at the question and look for the external market price. That's your answer. So in this question now, they said a company, oh, I should have indicated the question. So, a company has two divisions, P and Q. Division P makes component X, which is either transfers to division Q or sell it in an external market. Cost of making 1 unit of component X are this variable, total, variable. The second one should be the fixed cost and the total cost of 900. Division Q uses 1 unit of component X to make blah blah blah, which is all this one does not concern me. Now, what is the ideal transfer price range? If one, division Q can get X externally at 1,004, and if division Q can get X externally at 580, the answers are 1,004 and 580 respectively. No range in this case, because it doesn't change anything. It has to be because if you look, even if you look at this second one, this 580 is even less than the available cost. Yes, you still sell at 580. You are the one that know how you are producing your own at 600 when your mates are able to produce and sell at 580 externally. So you'll be chopping your loss quietly. And when it is 1 year and they are producing at 900, a 500 naira profit, yes, they are able to minimize their own costs and they get a profit of 500, which is also acceptable. So once there is no production limitation, your transfer price is just your market price, and that is that. So ideally, I think they've tested these ones and also these ones. A question that mentioned something like there's no external market once. I think this also once, but the real question, the major questions comes from this guy right here. When there's external market and production limitation, of course, we all know that this is the reality of things. There will always be market price and there will always be production limitation. There will always be. So this is the one that is tested frequently. So in this case, when there's an external intermediate market for the transferred item and the selling division has a limitation on the number of units it can produce. So anything can place limitation actually, but as far as this particular topic is concerned, it is most likely going to be demand. It is most likely going to be demand. But it can be material, it can be labor. Don't say labor can, demand can only be your limiting factor. If it is material, to manage it, yeah, you use your material to calculate the opportunity cost, and if it is labor, you do the same. But it's all you follow the same process. So if this happens, they said every unit transferred means okay, yeah. I skipped something. So the ideal transfer price should allow for the opportunity cost of the selling division. So this is where that opportunity cost that we mentioned earlier, this is where it comes into play. So when there is an external market and there's a production limitation, transfer prices are usually set at opportunity cost. You include the opportunity cost in your transfer price. So every unit transferred means one less external sales. That is, once I sell one to the guy internally, it means that I will be unable to sell that one to the guys outside. So that is what that particular part is saying. But in some situations, there are no ideal transfer price, as the company will be better off sourcing the component externally. Now, a situation like that will arise if it's in a situation, see the selling division, which is let me say division A now, can sell to the external party at 700. Why division B can buy from an external party at 500. Then it does not make sense for either of them for either Y to increase its purchase offer. So maybe from 500, you know, say, oh, let me buy from you 600. It doesn't make sense. And neither does it make sense for division A to reduce its selling price from 700 to 600 just to accommodate division A. So it's better for, oh, let division A sell to the external party at 700. Why we go and buy from the external party at 500? And at the end of the day, everybody will be happy. So that's what is meant by this place that added in bold. So let's solve this question and then we call it a day. There might be another class, probably Saturday, Sunday. I will talk to the other tutor to get a feasible day. And that one will be purely about solving ICANN past questions on transfer pricing. If you can solve 3 or 4 questions, I think we should be good. But yeah, so this question says a company consists of 2 divisions, Division A and Division B. Division A has a capacity of producing 1,500 units of product Z. Product Z has an external market. Yeah, we know. Now, Division B buys product Z, which is the buying division now, which it uses to make an end product which can be sold to earn excellent margins. Good for them. And Division A has the below selling and purchase details. Now, they can sell at 170 and the available cost is 19 naira. Division B wants okay. Yeah. I need this part. So division B wants 120,000 units. While division A, the external market rather, wants 70,000. So you are required. What is the ideal transfer price or range of transfer prices to division B? So first thing, when you see a question like this, is to check, do they have a limitation? Yes, they have a limitation. Now, what is their limitation from this question? Can anybody answer that? What is their
Demand.
limitation?
Demand.
Huh?
Demand.
The demand
Demand is not the limitation.
150
is their
units.
capacity. Yeah.
The capacity, 150 units.
demand
Production.
and the quantity, because the
Thank you.
capacity is 150, but the total
So their
demand there
capacity is just
190.
150. That's their limitation in this question. If you see, they have demands that is in excess of capacity, but at the end of the day, you can only produce your capacity. So that's their limitation. So we can now confirm that, yeah, there's an external market, and at the same time, there's production limitation. So how do we solve questions like this? Jump to the next slide. Whatever. Slide. Yeah. So for the solution, not thank you yet. So first, we check what will be the company's production. What's their capacity first? Their capacity is 150,000. What is their total demand? 120,000 that is coming from division B, and also 70,000 from an external party. They have a demand of 190,000, but a capacity of 150,000. It means that they can only produce 150,000, which is their capacity. So which is what I listed here. I showed here. So the production will be the lower of their capacity and demand. Now let's assume, just an assumption, this is 70,000. So it means that their total demand is 140,000. In this case, the question has changed. The limitation is no longer their capacity. The limitation is now what? Their demand. So because they can produce as much as 150,000 units, but their capacity, I mean, their demand is only 140,000. So in this case, they will only produce 140,000 because that's their demand. So let me go back to the original question. So since their capacity, Josh, you don't bring water. Yeah. Sorry, please give me a minute. Please, a minute. I don't know if I can catch myself. A minute. Okay. Sorry. Apologies. I had to attend to something. So, sorry, is anyone should confirm when my screen come back on? Can anyone confirm you can hear me? My screen back on.
Yes, sir.
Just come back.
Yeah, your screen.
Okay. You will not mind the background noise. But okay. So I was saying that their capacity is what they can produce. So or anytime you have a question like this, they have different demands, just add up the demands. If it is up to their capacity, if it is more than their capacity, they can only produce as much as their capacity. But if it is less, they can only produce as much as the demand. So it has to be lower of the two. So yeah, they can produce 150,000. And in an ideal situation, in a normal situation, you are expected to sell to your internal division or your internal clients before you go and sell to the external party in an ideal situation. And we always assume an ideal situation in this particular topic. So yeah, they have to answer division B first. So once they sell to division B, 120,000, they only have 30,000 units left to sell to external party. And how many units does the external party want? The external parties want 70. Where's my deal? They want 70,000 units, but they only have 30,000 left. So that means there will be a shortfall of 40,000. It means that simply because we have to answer this man that is inside, this division B that is inside, we are unable to sell 40,000 to division, to the external parties. So in that case, there's a shortfall of 40,000. So I said here that since A will be unable to sell 40,000 units to external buyers, then it should be sold at opportunity cost for division B. It means that you see this 40,000 that we are losing out, somebody has to pay for it, and it will be the person that is buying this 40,000. You know, this 40,000 is still somewhere. It's with this division B. It's part of this 120,000. Or let's say in a normal situation, let's go back to the question. You can sell to somebody at 170, and you can sell to another person at 19 naira. Now the person that wants to sell, that wants to buy from you at 170, say, oh, I want 70,000. Now, the person that wants to buy from you from division B, division B wants to buy at 19 naira, said, I want 120,000. In a normal situation, profit always comes first. So normal sense, we say, answer this guy first. This one that wants 70,000 at 170 naira, sell 70,000 to him. This one that wants 120 at 90, we only get whatsoever is left. That's true, right?
Yes, sir.
So that should be the ideal situation. Now, let me show you something. We said that should be the ideal situation, right? Okay. So in an ideal situation, let's ignore the fact that we're dealing with transfer pricing. Ideal situation. So you should have sold 70,000 at 170. Can someone please use a calculator? I need the figure. And sell, that will be remaining 80,000 at 19 naira. Okay.
$70,000 at 170 is 11.9 million.
11,900. Sorry, please give me a minute. Okay, sorry. Yeah, back. And 80,000 at 90,000 should be around, I think, 7 points something.
7.2 million.
7,200,000.
So 7,200,000 shows that we should have a total of 19,100,000. Right? Now,
Yes, sir.
Yes.
let's keep this figure. Okay, now let's come back here. But since we are not dealing with the ideal situation now, we cannot do it this way. We have to sell to the internal guy first, then sell to the external guy. Abi? So it means we are selling 120 to division B and 30 to division and to the external party. Unlike the 170 to external guy and 80,000 to the external that we did in an ideal situation. So I think I talked about this shortfall already. Now, how do we calculate opportunity costs? The opportunity cost, like we mentioned earlier, is the alternative forgone or the amount forgone. You know that, oh, normally I should have sold this thing, this 40,000 to the external buyers at 170, which is the market price. But now I have to sell to the internal division, which is division B, at 19 naira, which is the variable cost. So in that case, I'm losing 80 naira for every single unit that I sell. I'm losing 80 naira. So this 80 naira right here is our opportunity cost. So now, therefore, on this shortfall only, you will charge opportunity cost, and the remaining you don't charge opportunity cost. That's it. That's just what this place is saying. The moment you have a market for it, you will charge the opportunity cost on it. You know, I have a market for this 40,000, which is the one that I'm unable to sell to this external guy. They want 70,000, but I can only sell 30,000 to them. So this 40,000, I still have market for it, but I could not sell it simply because I sold to division B. So in that case, it should come at opportunity cost. Now, this 40,000, you will not charge it at 170. Now, you see this going through this process of opportunity cost, blah, blah, blah. You necessarily don't need to do it in exam. From here, I can jump to this place straight. Just note that any shortfall must be transferred at the market price. That's just it. You see this opportunity cost, I'm just using it to explain what the concept of opportunity cost is. But for calculation or for your exam sake, you don't need all this extra explanation. Just know that any shortfall must be transferred at the market price, and the balance should be transferred at variable cost, as simple as ABC. So when you are transferring 120 to division B, in your invoice, you just say 40,000 at 170 naira and 80,000.
19 naira per unit.
So at 19 naira.
Yep. Now let me bring it out. Now, you know, there was still external sales.
Yeah.
Now,
The
how many
balance of-
units? The 30,000, have you?
Yeah.
And we are to sell to them at 170 naira, which is the normal external price. Now, if you go again, how do I bring this up? How to bring this up? Another person should do 30,000 at 170, and another person should do 80,000 at 90.
Oh, my calculator thing was sure.
170 is 5.1 million.
5.1 million.
13,600.
Sorry,
Yes.
13,600.
1 million.
sorry, let's
80
take
by
one after the
1.
other. What? Please, let's take it one after the other, please. 40,000 at 170, how much?
6.6 million.
6.8.
Yeah.
Okay. Yeah, the next one.
80 by 170.
No, there is nothing like
There's
it.
no 80 by 170. 80 by
720
90. I think we did this
That's
better last. It's 7.2 now. Okay.
Yeah.
And then this third one, 30,000 at 170.
5.1 million. 100,000.
Good. Now, if you do the addition of these three, again, you should arrive at 19,100,000, which is the same amount they would have gotten if they went through the ideal situation. Or can anybody confirm? Please, someone should confirm that the addition of those three is exactly 19.1. Let me go back to the slide. So 6.8
Yes,
plus
19.1.
19.1. So you see that once there is market, division A does not have to lose any amount. You know, the ideal situation we said is transfer 70,000 to the external guy, 80,000 to the internal guy, and you get 19.1. But now, you still have to sell 120,000 to the internal guy. But simply because you'll be losing out on something, that thing that you're losing out on, you have to still charge the internal guy. That's why the 40,000 is coming at 170. This 1,000, you still sell it to them as if you are selling to the external guy, 170. So it's only the ones that you don't have market for. You know, if I remove transfer division B from your customers now, division B say, oh, they're not buying from you again. Of course, you can only produce 70,000, because if you produce 150,000, your 80,000 units will be of waste. Nobody will buy it. So that 80,000 that you don't have market for, so is this 80,000 here? And that's why you're transferring it at your variable cost. And of course, the external sales of 30,000 at 170. So that is how we determine transfer price, the ideal transfer price when you have opportunity cost, or when you have a market with production. So yeah, I think that will be all for this night. So if you have a question, kindly raise your hand. I will share this updated slide on the group after the class. So if you have a question, I think now is the best time to ask. Let me stop presenting.
Please kindly drop or maybe some complex assignments.
Should I drop assignments now, or should we solve question first? Okay, I will send an assignment that looks like this one that we just did. Okay, Oluchi, is it Oluchi or Oluchi?
Okay. Yes, sir.
Oluchi.
Please, can I see the last solution? I want to ask question then.
Okay. Coming.
Transfer price.
Okay, sir. My question is on this shortfall of 40,000. Where are we charging 170 at the shortfall?
Huh?
I thought you said that 40,000. Here now,
Yeah.
this 40,000, the shortfall.
Yeah.
What we did here, we charge 170 to it. I thought what we're supposed to charge to it is the opportunity cost for gone, which is 80,000.
No. You cannot charge it here. Now this is how opportunity cost works. Now let's be practical. Just pick something that you sell. I mean, it might not be what you're selling in real life. Just pick anything. I want to be practical with you. What would you like to sell?
Okay, let's say calculator.
Oh, you sell calculator, fine. Okay. All right, you sell calculator. Now this is it. You have two customers. One of them is your very close friend, but one you don't know the person. Now you can sell calculator to the external person that you don't know at all at 500 naira. But to the person that is internal, you can sell, you'll say, because this person, I know this person, let me sell it at 300 naira. Now you are losing money, Abi. Now you are losing 200 naira. You are losing 200 naira. Yes. Now that is your opportunity cost. Yes, that is your current opportunity cost of selling it at 300 naira. Now, if I now want to say, this thing, I don't want to sell it at 300 again. I want to include my opportunity cost in that amount that will sell it to the internal person. It means that I'll go to bring the 300 that I sold it, go. You bring it back, that 300. Then you still now add what you lost before, the 200 that you lost. You still add it back. I don't know if you understand. Or let's say you'll be selling that 300 on a consistent basis. You've been losing the 300. One day you just decide that, I'm not doing it again. I want to add back my opportunity cost. It's not that you will remove the 300. You will add whatever you've been losing to the existing price. That is why we are adding the 18 naira that we are losing to the 19 naira that we are supposed to sell it to them normally. We are supposed to sell everything at 19 naira. But because of this 40,000 is a shortfall from our external demand. So we have to add that 18 naira to the 19 naira that we are supposed to sell. This is not a minus, please. So how do I indicate it? Let me just show a column. So it doesn't look like a minus.
So maybe I can buttress it in this way. Had it been the external demand had also been 150. So they would have been selling at opportunity cost the whole of the goods to the internal demand at opportunity cost instead of at variable cost.
Oh yeah. It's just whatever this difference is. If this is 150, of course, you just see 30 minus 150, you have 128. It means the old 120 will be at opportunity cost. That's just what we are saying, and thank you for that. So I don't know if you understand now, Oluchi.
Yes, sir.
Okay.
Hello, sir, I have a question. According to
I'm coming.
our
I know I saw a pop over. Sorry, who is speaking?
Michael,
Your voice
sir,
is low.
can you hear me?
I can barely, but continue.
You just stopped sharing. But anyways, let me just still ask. That 8,000 naira
Okay.
that we sold at 19 naira, what is it for? Sorry.
The I'm not sure I get your question.
The 80,000 that we sold
She
at
asked
90.
80,000 units, what at 90 naira per unit, what was it meant for to be sold at
Okay,
90
so
naira?
let me share
Yes,
again.
thank you.
I'm presenting now. Oh, if I get you clearly, you are talking about this. Sorry, the one please. This 80,000 at 19 naira a year, right?
Yes, yes.
Okay. Now, I'm not sure. I think I mentioned it, but let me just buttress the point again. Now, when you are selling to an internal division, the first thing on your mind is we are not making profit or any contribution from this sale. So if that is the case, it means that this guy that want to buy 120,000 from us, we are not supposed to make anything from him. We are not supposed to add anything. As far as transfer pricing questions are concerned, you are not supposed to add anything, because assuming he's not buying from you, you are not producing it. You don't have anybody else to buy it from you. I'm just assuming we don't have external demand now. You is your only customer, so there's no point. You don't need to make profits from him, because if you make profits from him at the end of the day, it's still a zero profit to the company as a whole. So why sell higher for him? Just sell lower so that his own cost of sales can be probably lower, and then he can be able to sell more of his products to the external whatever the arrangement is. But the fact that, so just like I said now, the old 120, normally we should have sold it at 19 naira, which is the variable cost, right? But out of the 120, we know that 40,000 of it on a normal day, we should have sold it to the external party at 170, right? Now, we sold 120 to him. We said, oh, 40,000 out of it, we cannot sell to you at 19 naira. We can only, we sell it at the 170 that we're supposed to sell it to the external party. So fine. So from the total 120 now, we have charged 40,000 at 170. So it automatically means that the rest has to be at variable cost, which is the 19 that we're supposed to even sell the whole 120,000 in the first instance. Or if you don't want to go through that route, if you want to follow another route, just look at their capacity. Their capacity here is 150,000. Look at their external demand, 70,000. So it means that they have no external demand for the remaining units, which is what? 80,000. So that 80,000, you cannot make any profit from it. So it has to be transferred as variable cost, except the question says otherwise. So that is again this 80,000 here. So did I answer your question?
Yes, thank you very much. Yeah, you did it
All
well.
right.
Thank
All
you.
right. Do you have any other hand up? Or let me check YouTube if I can read out any question there. Oh, I just hope they've been hearing me. I'm not seeing
85,000 units. If I must transfer from A to D.
Okay, I'm not seeing any question on YouTube, and at the same time, I'm not seeing any hands up. So I'd like to call this class to bring this class to an end. We'll meet again. I just hope we are able to before the week runs out, at least able to cover up for the class we missed. Maybe Saturday or Sunday. I will raise a poll on it, and it's latest tomorrow morning. If I've not dropped the question that I promised, somebody can just remind me on the question. Okay, so thank you all for participating in the class today. I hope you all have a great night and a great day tomorrow.
Thank you.
So till next time we meet. Au revoir.
Thank you, sir.
The transfer price be to money. Can't tell me,